I think what we're finding right now is that in the current rate environment, with things being so high and volatile, what everyone wants to know is like, when are rates coming down, right? Like, what's the perspective or
what's the forecast?
The future looking like?
Right.
And generally speaking, honestly, I think the mortgage world is preparing for just higher for longer.
Yep.
Like the Fed, they meet up every once in a while, not just to make policy decisions, but to just talk and have meetings, and they'll put out meeting minutes. And a lot of what happens with mortgage rates is based off what the Fed messages, and then in between that, what economic reports come out.
Yep.
And the problem is the Fed's waiting for inflation to get down to 2% before they really consider even.
It's like the soft landing number I think they're looking for.
Yeah, and then every time they meet, they give this messaging. And the last time they met, they actually surveyed the members to see what they thought would happen next year for rates. And there was even a large swath of them who thought they would go up another 0.5%.
Interesting.
So even that messaging can have a negative effect on mortgage rates, because it really all comes down. What mortgage rates actually come down to is how like traders on Wall Street trade.
Right.
You know, hedge fund managers and mutual fund managers, they can invest their money that they're managing into stock. They can do it in treasury bills. They can do it into mortgage-backed securities.
Right.
They invest how mortgage-backed securities are trading is what actually drives interest rates in the mortgage. Kind of like the Big Short type stuff. If you've seen that.
Yeah, it's like that Jenga tower.
Exactly.
Reality,
Every one of those pieces of mortgage, every one of those mortgages has a rate of 7%, right?
Yep.
And then that mortgage-backed security can pay a yield of 5% to anyone who invests in it, and that's how they make a 2% spread.
Yeah, smart.
Depending on the supply and demand of mortgage-backed securities, the yields will go up or down. Therefore, the rates people can give on mortgages to maintain that spread go up and down.
Yeah.
So all the news, all the economic crap that comes out, how that affects mortgage rates is what are traders doing with mortgage-backed securities. So very positive jobs reports, you know, inflation numbers still coming in higher than expected, or, you know, Fed messaging, all that stuff can play into it. Like last week, maybe it was 2 weeks ago, there was a jobs report that came out that they were expecting 170,000 new jobs, and there was 330.
Right.
Which is crazy. It sounds, that being good. It's good news for the economy, but supposedly, but to the Fed, that's not that economic slowdown they're looking for. So to be like, we haven't hit inflation yet. We need to keep raising rates. And so traders go, that's not what we're looking for. That's not what the Fed's looking for. And what happens? They invest in other things. So like that was actually bad news for interest rates, and the rates went up severely because there was so many more jobs than expected. So it's like, it's weird. It's like a weird kind of causality thing. But at the end of the day, it's what mortgage-backed securities do that dictate the rates. With some of the messaging out there, with lenders just trying to be prepared for the worst, it's like our mantra right now is higher for longer. That's what we're preparing for. And so if we assume the rates were to stay this high for a long time, there winds up being like 3 big obstacles or objections I'm finding, and really everyone's finding, with buyers, right? And this applies to sellers too, because the sellers need buyers. So at the end of the day, in the market, there's 3 big objections right now. And they all relate to either qualification, comfortability, or competitiveness. Because first off, people need to qualify. Right. And if they can't qualify, that's their issue or their obstacle. We have to figure out ways to try and help them with that. If they can qualify, they might not be comfortable. If they're not comfortable, we have to try and find ways to get them more comfortable if we're going to keep them active.
Right.
If they both qualify and they're comfortable, now we have to hope they're competitive enough where we can actually win in an offer situation.
Right.
And there's certain strategies that will only help with one, might help with both, or might help with all 3. And it's kind of important to know, more important for a lender to know which helps with which, but definitely useful for a realtor to know, so you can speak to a little bit and have a sense over what might work for people. But at the end of the day, the big thing is just push them over to me and just be like, hey, it sounds like you're having trouble getting comfortable, or you're not sure if you'll qualify. You know, there's some options out there, XYZ. You know, if you want to know more about them, talk to so-and-so.
Right. Yeah, interesting. It's almost like kind of like balancing the scale of like affordability, comfortability, and then putting the offer in. Because if you have boxes 1 and 2, comfortability and affordability, then you're kind of like, oh, I have a great offer in a not great
Yeah.
market environment. Let's be a little bit less competitive and
Right.
more on like the buyer friendly side,
Yeah.
which maybe is contrasting with what sellers are expecting, which they've had for the past few years, a super seller's market where list price was a suggestion, it's going to go way over. And waive all the contingencies. Like people were saying, waive the mortgage contingency, waive all the other things that you could. It's definitely a lot different and we're starting to see that a lot more heavily now.
Yeah.
I'm seeing it, so it's very different.
Yeah, it definitely is, and I've seen way more homes sit on the market. Ones that if it's not like there was one I helped out an open house this weekend, and it was 725 in Burlington. Really nice bones, nice split, a little out of date, and that used to not matter. It would still be 15 offers, 100K over. Different story now. All we were asking, a few offers, but not the same thing. The realtor was honestly nervous that it was going to sit.
Yeah.
Never used to be worried.
It's tricky. It seems like that's the case with a bunch of. It's obviously market dependent, but like I'm seeing that in all asset classes, like single family, multifamily, a little bit, and then condos. Kind of agents. I put an offer in for a client of mine, I think a few weeks ago, and it was under asking, and I'm like, wow, this is crazy. Like it feels weird doing an under asking offer, and it was like, yeah, let's keep the contingencies in there, and it got accepted, and it was like, wow, like good for us,
And
it wasn't like a counter, like, hey, can you come up? Can you ask or take away the contingencies? It's like works for us, and they've been super relaxed, which is like it's a weird dynamic, but it's good to see a little bit of a shift.
And so then depending on the borrower, any one of those three things could be the issue, right? Because you could have someone who's reckless and qualifies with mass housing with 3% down payment assistance, and they're comfortable, even though they probably shouldn't be because it's super tight DTI or something. But very competitive like offer scenario either necessarily. So it's like, okay, minimum down payment assistance, high DTI. You have two of those checked off, but you're not that competitive. It could be that you're super comfortable because you're a self-employed borrower who makes way more money than you claim on your tax returns. And that you can be competitive with your offer. You have a ton of money for down payment and you're comfortable going to the top of your limits, but your qualifications tight because you're self-employed, you're kind of assessed differently. So, you can run into any one of those things. And so when I try and categorize the strategies, it's based off of like, what are we trying to solve? You're talking to a client, you're hearing what the problem is, whether it's an objection or whether it's an obstacle. Talking to them when you're talking to the lender once they talk, when you're finding out what are the sticking points we have to work with. If it's qualifications, basically the three main things that I find help there are going to be permanent buy down, so paying points to lower the interest rate. There's an AMI product out there these days. And hold on, let me open up the PowerPoint so I don't have to speak out of turn. I can just remember exactly. Hold on 2 seconds for me. Actually, if you want, I could probably share my screen, no?
Yeah, go for it. I think it's a little button right there. Let me know if it doesn't give you permission. I'll just probably have to fix the settings.
Okay, bear with me for a second.
There you go.
Sorry, computer's being slow.
Oh, you're good. Mine too. It's weird. I was talking to a lender a while ago. Actually, no, it was actually yesterday. It was one of the sponsors at the conference thing, and they're saying the DSCR can go down as little as 75%. I don't know, like.
What do you mean go down as little as 75%?
So like just the ratio, like 0.75.
Oh, gotcha.
Yeah.
I mean, it could be. The thing with the DSCR loans, I don't know why I can't get the PowerPoint to actually pull up, which is fine. I can just kind of speak to it. Hold on 2 seconds for me.
There you go.
Yeah, the DSCR loans, they probably, I mean, they're non-QM mortgages, so there's no like Fannie or Freddie guidelines on exactly how low they can go.
Right.
So it's really up to the individual lender, and the lenders are harder to come by because just the non-QM, they're riskier. So there could be ones that'll go as low as 0.75, honestly, which for a lot of different circumstances might be great. I think when you're using the non-QM stuff, you just have to be able to self-assess on if it's a good or a bad idea, because the lender's not going to be able to tell you.
Right.
It's like the lender's just like, yeah, we can do it for you. It's
anything's possible.
You're comfortable with it, you know what I mean?
Yeah.
So that's very possible that there's something like that out there. I know a dude who I helped him buy his primary as an FHA, and then he bought his what was it? Primary FHA, and then he bought an investment in Connecticut at 25% down. And then I was like, you know, there's not too much creativity in my world. There's DSCR, and then there's saving up another 25% to buy more investment, or 15% to, at the time, 15% to owner occupied 2-family.
Yep.
If you want to move to a new one. And now that's obviously changing down to 5%, which is pretty huge.
That's cool.
But I was explaining that to him. And then he reached out to me again now, which is like 10 months after the last purchase.
Yep.
And he's like, yeah, I have 24 more units. And I was like,
whoa.
What? He's like, he like owner financed one. He got commercial stuff and partnered up with people, get down payment for others. So if you get creative and you talk to enough people and just get savvy about it, you can find stuff. It's just like me, like us.
Yeah.
We do like the, you know, if there's one way to get from, we're the highway. If you want to get from Mass to Maine, not a lot of creativity. There's just one highway that goes there. If you know the back roads, you can do a lot of other stuff too, you know?
Yeah.
But it's like to travel the back roads. You need to talk to more people and get the direction. So it's like, there's always creative stuff out there. You can probably figure some stuff out. But, you know, even the DSCR is not that crazy. Like there's certainly some weird lenders out there who would do some weird stuff. But the more weird you get, the more you have to be able to be like, am I comfortable with this? Like, you got to check
more accountability. It's like, it's not like, can I do it? Or it's more of like, can I do it? Or like, do I want to do it? Like, what's the leverage here? And if
have you seen the original Jurassic Park?
I don't think so.
Like 1990.
Before my time.
It's a great movie. I always refer back. It's like literally there's like one line with the dude making dinosaurs and shit. And there's a dude who's like, you know, you were so caught up to figure out if you could do it, you didn't think about if you should do it. And it's like that kind of applies to a lot of things. I feel like it's true. It's like you can buy it in a lot of these funky ways. It's just you know, double check yourself. Like, should I do this?
Make sure it makes sense, especially like depending on the market too. Like, can you even do it? And then kind of like from there. That's a lot. 10 months, 25 units. That's
wild. But about big like seven unit buildings, like 5 unit buildings. So it wasn't like condo. It was a couple of transactions that totaled up to high units. You know.
So what kind of stuff did he do? So he said like curated financing. So you would just like talk to the owner and like work out a plan with them, or?
Yeah, I you know, that's to me just you got connected up with someone who was looking to sell, and you guys worked out your own, because you can make a mortgage with a person. You know, if you have an attorney that can drop something legal, you make an agreement. It doesn't even need to be recorded at the registry of deeds necessarily. The deed would to make you a legal owner. They want to know who owns it, but the mortgage doesn't necessarily need to be recorded. It can be like a personal note between 2 people.
Oh, that's interesting.
So an attorney can draft something up for you. You can come to an agreement. If it was Texas, I'm sure it could be on a napkin. You know what I mean? Do something more official up here. But like, it's still, you can draw legally binding documents. So whatever, make a deal. You know?
Weird.
Yeah. So, but so the strategies in this market though, like qualification wise, you know, we've all heard of ARMs, 2-1 buy downs, the AMI product I can explain a little bit. I think I already did to you. There's permanent buy downs of discount points. And then I also consider debt payoff to be a strategy.
Interesting.
Now, comfortability wise, 2-1 buy downs and ARMs, those will improve your comfortability, not your qualifications.
Got it.
The reason being, An ARM has a lower rate during the fixed rate period, which will make you more comfortable, but you don't underwrite the loan to that lower rate. You underwrite it to a higher rate called the fully indexed rate.
Yep.
It's a margin plus an index. The index is something like the 10-year treasury bill.
Okay.
As published by New York Wall Street Journal. It publishes daily. So you go look at it. That's the index. The margin is usually like 2.25%. It's defined by the product itself.
Got
So
it.
you take the margin plus the index, you add them. That's the underwritten rate.
Okay.
So it's usually higher than the actual rate you're getting on the fixed rate period.
Yep.
That rate's the rate you pay when you get it for that fixed rate period. So it makes you more comfortable, but it doesn't lower your rate for underwriting purposes. So it doesn't really improve your qualifications. It just makes you more comfortable, you know,
Got it.
similar to a 2-1 buy down. You know, a 2-1 buy down is a scenario where, you know, you're offering $700,000 on a home. The rate's going to be 7.5%, but you want to be more comfortable. So the lender can give you a 2-1 buy down where the first year the rate's 5.5%, 2% lower than the actual note rate. The second year can be 1% lower, 6.5%, 1% lower than the note rate. Third year, it's the note rate, 7.5.
Yep.
So it's huge savings in those first 2 years, but where does the savings come from? How can the lender actually give that to you? Well, either the buyer or the seller is funding an escrow account, basically a holding account. They put this money in the side here. That is enough money to subsidize the payment for 2 years. There's no true savings in it.
Yep.
Whatever you're saving month to month in year one for having 2% lower rate, the lender calculates how much that is. That amount of money needs to be
back on
holding account.
Okay. Interesting.
Next year, there's a 1% savings. That amount of money needs to be put in the holding account. So you can have a buyer who self-funds a 2-1 buy down, but it doesn't make too much sense because it's their own money that's subsidizing it.
Yeah.
The only way it makes sense is if they have so much money that they just don't care about having that money in control by the lender for a while.
Yep.
To subsidize their own payments because they would rather pay money up front to make it easier on themselves the first 2 years.
Yeah, interesting.
The only reason why it makes sense for a buyer to finance it. It makes tons of sense to get a seller to finance it. It's just where can you use it? And that's like, you know, if we were working together and you were offering below asking on that condo a week or two back, I might have been like, don't ask 10, 15K under asking price. Ask for a $15,000 seller credit and offer asking price.
Oh, interesting.
You're going to get the same amount of money at the end of the day, but they'll give you some of it back that you can use to subsidize your closing costs. And then you can use the seller credit to either buy discount points to permanently decrease your rate or to fund the 2-1 buy down. And then your buyer is saving money with the seller's money instead of their own.
Good to know.
The nice thing on the 2-1 buy down is all the funds in the holding account, they don't disappear. If they refinance in those first 2 years while the rate's still discounted, all that money goes to principal reduction when you refi.
Oh, it's interesting.
You never lose it. Whereas with points, you pay that to get your permanent buy down on the rate. But if you refi really quickly and you paid $5K at close to save $200 a month, and you only got through 12 payments,
probably not worth it.
$2,600.
Right.
With the 2-1 buy down, you never lose it because you just goes to principal reduction when you refi.
So it seems like people are probably more inclined to do that now.
So the 2-1 buy downs, the 3-2-1 buy downs, they had a hot moment in December last year because everyone thought the rates were going to come down in June to 5%. And they were like, homes were on the market during the December longer last year because people were freaking out about the 7% interest rates when we hit there. And so there was a lot of talking heads in the mortgage world who were like, 2-1 buy downs, do it, do it, do it. And that's where they got popular. And then it got way too busy to do it again because nothing sat in the market. But now that we're seeing price reductions in the market for 2 weekends, I always show people, because I tell my clients to reach out and tell me what they're offering on and what they're thinking about before they do it so I can crunch numbers. And when I see something on the market for 2 weekends, I'll usually show them asking price and 10 or 20K below. And then I'll show them asking price with a seller credit of 10K or 20K. And then show them what it looks like to buy points or to do a 2-1 buy down. You can kind of see that sometimes there's more of a benefit to not asking to go under, but to ask for a seller's credit and use it for a reason.
So that math in the long term seems like it'd pay off a lot more than the upfront of like, I'll save 10 grand or whatever it is.
It's my thing is you want to consider all the viable options, because if you have to pay 2,500 in points to save 150 or 200 a month, that's not a bad deal. That actually is a way cheaper way to save a decent amount of money. But if you have to pay $7,000 in points to save 200, a month, that might be a more risky play because it's a long time before you make that money back.
Yep.
Whereas the 2-1 buy down, you never lose the money. So that's a lot more savings in the first 2 years that you won't lose if you refi. The key with the 2-1 buy down is you want to make sure they're comfortable with their payment at year 3, because it's a fixed rate. It's not going to go up anymore. But if they're not comfortable with that payment, then you only have 2 years to refinance before you add that payment.
Yeah, kind of like a time limit.
Right. And with the arms, they have longer fixed rate periods. So there's more runway to get to that risky time. The thing with the arm is when you get to the risky time, it's way riskier than a 2-1 buy down.
Yeah, because there's a minimum, not a
it could jump 2% every year. Whereas with the 2-1 buy down, if you're not comfortable with that note rate, it's like, oh no, that could get uncomfortable when you get there. But it's never getting worse. Year 3, that's what it is. It's fixed. So it's like there's less runway on the 2-1 buy down, but there's more security at the back end when you get there.
So is anyone really doing like 30-year fixed right now? Like, is it?
Yeah, that's the majority of what I'm doing.
Interesting. Okay.
Sorry,
go ahead.
Oh, I was gonna say the arms actually aren't that competitive.
Okay. From the offer standpoint.
Well, from the offer standpoint, basically, and you're probably getting here, you can still find some arms that are better rates, but they're not as easy to find. If you find them, from being frank, which isn't something maybe it's not good for me, but it's like, if you're going to find them, it's going to be at like these tiny little lenders who, if I'm being frank, don't know they regret it already. Like give out the rate, and then in a year or two, when they have to borrow from the Fed at a much higher rate, and they have all these loans portfolioed on their books that are making interest, it's like way low to what the market is. Only then do they go, oh yeah, we messed up. Like this is
they want immediate business, immediate gratification. To then be like down the road,
right. They have their yearly goals. They haven't hit their mortgage budgets. They feel like they're being heroes because everyone's like, oh my God, you guys have the best rates. And then either an auditor comes in and tells them their books are getting really messed up and you have to change this, or they self-assess down the road and go like, oh crap, like we're having issues, because they have to keep a certain amount of their deposits, not lent out. And so all the portfolio loans are basically against their deposits. It's on their books, and they have to keep a certain amount of capital reserves. And so at some point you stop having the ability to lend out portfolio, and the loans on your books are just the rate they're at. And so if you have these low rate loans and you borrow money from the Fed so you can continue to lend, but the money you're borrowing is a higher rate than the loans you gave out, the banks are like, ooh, we fucked up. The client's not going to hear about it. They're just going to remain happy because they have a lower rate. And it stinks for us while they do it, because if we don't have access to those products, because we work with a lot of local lenders, we have access to their products, but we do enough business where typically those local lenders fill up on what we do. So we do it for them, and they're like, okay, like we're full, we're good now. The small ones we don't work with, the bigger lenders don't work with, is what I mean when I say we. They will see those rates stay low for a little longer. Because they just don't do as much business. They don't fill up as quick. It's like, one kid at dinner ate really fast and one kid eating slow. They're both going to fill up, but it just might be at a different pace.
Yeah, different pace. Interesting. That's a good analogy.
So you can still find good arms, but the truth is it's not as easy to do. And so the arm, but the arms, they solve the comfortability question, not really the qualification. Same thing with the 2-1 buy down. That solves comfortability, not qualification, because the rate you do it off of is the higher note rate. The permanent buy down of interest rates, paying points, that improves qualifications because you're actually permanently lowering the rate. So if instead of getting 7.5, you're at 6.75, that's what we qualify you on. It's permanently down. That's the
number that we're working with.
And then the AMI product, that's the one where if you have someone on the app who's a first-time home buyer, and the application you need on the mortgage to qualify people is less than 100% of the area's median income, or in high value area, less than 120% of the area median income, then you're not subject to any rate adjustments. So essentially, if you're buying a condo, typically there's a higher rate. You don't get that hit. If you have a 680 credit score, you have a higher rate. You don't get that hit. If you're putting less than 20% down, increase the rate. You're not getting that hit. So it gets you a bare bottom rate, regardless of your kind of scenario. It doesn't get you a 6.5. It gets you like the bare bottom no adjustments. So your rate doesn't go up. It doesn't come down either. You still,
Right.
you might use the AMI product and pay points to get your rate below market. But the AMI product keeps your rate from going up. So it can help qualifications for your 680 credits. It'll increase qualifications for a 780 borrower putting 20% down. There's always a little bit of a benefit to that product, but more for the worst borrower.
Yeah. So did you say it was only for like first time home buyers, or?
One applicant has to be a first time home buyer.
Got it. So is it a one-time use? So I know like FHA, it's like people think of it as like a one-time use thing, but you really just can't have multiple FHAs at the same time. Is it similar in that regard?
No, it's not. It's truly first time home buyer. So one applicant has to be a first time home buyer, only one.
Okay.
Because you're right, FHA isn't a first time home buyer program.
Right.
It's just outright not a first time home buyer program.
Yeah.
There's no home buyer requirement. There's a requirement on how close is the other home you own. Is it already FHA? There's all these things to make sure you're not investment. They don't want you to acquire investment properties via FHA.
Under FHA.
That's what it's based around. It's not based around first-time homebuyer status, which is funny because like literally that's like the reason everyone uses FHA the first time around, unless your credit score is bad. If you're buying a single-family FHA, it's because your credit score is bad. Everyone went FHA for multis to get their first investment property, and they're like,
or whatever
for a year,
Yeah.
But that's what's so cool about the change to 5% down conventional. It's about to change. That's going to be the way most people are going to want to go about their investment property purchase, is my bet. We still have to figure out, is there going to be a reserve requirement? Are they going to have stricter debt to income ratios? Are there going to be rate adjustments for doing it this way? We don't know that stuff yet. All they said was 5% down.
Yeah.
That's the only thing we really know. So we can find out more as time rolls on.
Yeah.
But predictably, it sounds like it's going to be a way better option than mass housing or FHA to be able to just go conventional like this. No. You remember the 3 families we were talking about? How that has the no self-sufficiency test anymore. You don't have to worry about. If you're in Lowell and you can justify buying a 3-family at 5% down and you're okay with the payments, I don't have to say it's impossible to buy a 3-family FHA in Lowell. You'll never pass the self-sufficiency test. It doesn't matter anymore. You know what I mean?
Yeah.
So there'd be huge advantages to it for sure.
Yeah. Interesting.
Theoretically, I've also heard no one say that you can't use the AMI product. It's a guideline change, not a new product.
Yep.
So the AMI product should encompass that 5% down 30-year. So if there's rate adjustments for less than 20% down for being a multifamily property, theoretically, I think you should still. I've heard nothing that would mean you couldn't use the AMI product to go 5% down on the multi, which means if they do hit you on rate for buying the multi, but you can hit that product, no rate adjustment.
Oh, interesting.
So theoretically, you might be able to use existing conventional like appraisal waiver guidelines and products on top of the 5% down, because all they do is change the guideline. They didn't make a new product, and now you either choose this product or that product. This product can work with that guideline. So I think you might be able to get no rate adjustments on it if you are a first-time home buyer under area median income. It would be like, 1% increase for multifamily, not for me. I have the AMI product, Yeah.
So I feel like that'd be a really good tool for first-time home buyers to even like get into like their house hack and like be able to buy a bit more if they're okay with the payments. Yeah,
I think with the FHA, the mass housing, a lot of people felt like, oh, you can't qualify for a single family. Well, think about doing a 2-family. Maybe that'll help you out. And it's like, well, it's not, because you're jumping up in sales price too now.
Yeah.
But it might be a little easier with this product to do it. I think we'll have to see how it goes out in real time. But I think
that'd be interesting to see. So when do is it November? What do you know what day or?
November 18th is when it becomes like, because the way it's going to work is Fannie Mae changes the guidelines, but the guidelines are reflected when you run your automated underwriting systems.
Okay.
In the mortgage world, when we run, you're going to hear like automated underwriting system or AUS or approve eligible, DULP.
Yep.
It's all basically referring to the same thing. Oh, shoot. I just remembered. I have a 12 I have to hop off for. So
yeah, totally fine. Whenever you're ready to go. Yeah.
This way, underwrite, there's these programs, LP and DU, and all the guidelines we read about, the 10,000 page booklet of guidelines, the searches we can do. Yep. It also translates through the underwriting system. The underwriting system is what spits out the answers to you.
Sure.
And so the 18th is when they update the underwriting system. And
Got
that's when we're going to start learning way more, unless they publish more info for us to read. Because what will happen is we'll submit something we think is going to get approved, and then it's going to give a denial. And we're going to be like, why? You can do a 5% down. And then you start toying with it. Well, what if they had 6 months reserves?
Oh, got it.
Prove you need reserves with this. That's what you need to do.
Okay.
So it's going to be trial and error. And we're going to be able to figure it out at pre-approval. It won't be an accepted offer.
Yeah.
Because when we pre-approve people, we run it through the AUS, just missing a property address. And so we'll find out if it's going to work when we're pre-approving people.
Yep.
And if it doesn't, we'll be like, well, why? And either the findings will say lack of reserves, this, that, the other.
Yep.
It won't really say anything. It'll say too many risk factors. And you go, well, what the hell does that mean? And then you start toying with the file. Okay, let's pretend they had this much reserves. That was reserves. And eventually, if it goes accept, we go, that's one way to solve the problem if you get it.
Got it.
The debt to income's 45%. And we're like, well, that's the problem. What if the rent was this much more? Or what if they made this much more?
Yep.
And then you trial and error to be like, oh, so it's a DTI thing. We got to keep it below. So there's going to be a learning curve. No one's saying it. I think lenders sometimes see positive news and they're like, I want to be the first to break it.
Yep.
Great. But I like more the approach of like, I want to be realistic here, guys. This is definitely good news, but we don't know everything yet. We got to figure it out when time comes.
Yeah.
Now there's more to discover, unless you want to dive in head first and potentially upset a few people when you learned on their cases, you know?
Right. Yeah. That's interesting.
But yeah, so the 2-1 buy down, so the qualification ones, the AMI, or the permanent buy down, and the debt payoff's huge too. So I love mentioning this to people because essentially, if you can do a 10, 15, or 20% down payment or more, right? Yep. Everyone just throws their money at down payment because it's more competitive. You know, I want a lower loan amount, better payments. But both qualification wise and comfortability wise, it can make sense to reassess where you're putting your assets. If someone's less comfortable or needs to qualify for more, $25,000 extra on your down payment is going to save you like $150, give or take.
Yep.
Maybe 175, 200 when you're talking higher interest rates. What if you had a car loan that had $25K left on it that you pay $500 a month on it? Way better use of your money is to pay off that car loan than put $25K extra down.
Right.
If your client's uncomfortable because their monthly cash flow is not working, hey, well, Mr. Client, I have a better way for you to feel comfortable. Don't put it all to down payment. Pay off some of your debt with some of what you thought you'd use for down payment. Now your monthly budgeting is better.
Yeah.
You need a little more purchasing power to be competitive on a specific home. Yep. Don't put the extra down payment. Pay off that car. Now you can take on a higher monthly payment and I can qualify you for more.
Right.
So paying off debts, like best assessing how to use your assets, can be a way better use of your money if you have a large down payment. So that's one that's both comfortability and qualification.
Yeah, interesting. Kind of like fixes that DTI issue on the front end and then worry about it. Yeah.
Yeah, there's
real a better use of your money.
Comfortability is real life. Qualification is mortgage. They're the two different things. So some things solve real life, some things solve mortgage, some things solve both. The debt payoff is huge. It can be both because if someone has 20 or 25, they're like, no, but 20% down is what I heard I need to do to whatever. It's like, not really. Like, not really. If you want to go, 3% less down so you can pay off $15K car loan and save yourself $450 a month, like that can go ways. That can matter, Yeah.
So is that similar to with like student loans then? You
can do it with student loans.
Yeah. Okay.
It's about the monthly payment. On the mortgage side, it's about the monthly payment. It's not worth it if you're not getting more bang for your buck as far as dollars spent to dollars saved monthly. That's the big assessment,
Yeah.
So generally speaking, like 35, 40, when I see 25, 30, 35K debts, I'm like, people probably don't want to pay those off. It needs to be a pretty high payment to justify it. But if there's like a 10, 15, 20K car loan, they're paying like $600 a month. It's like, dude, pay that. Like that's so much use of your money, honestly.
Yeah, literally.
So just because I want to get two or three more things in there before we're done. I want to try and riff through competitiveness. So we kind of covered the comfortability, we covered the qualifications. Now you have competitiveness, and these are just strategies. The two things that I always say you should consider if it's within your ability is first off appraisal gap coverage. Have you heard of that?
Yep. Explain. I'm gonna butcher it.
Well, so there's two ways to do it, and everyone knows one. If the appraisal comes in low, you bring cash to make up the difference, right?
Yep.
Very straightforward. But if someone's putting 10, 15, 20% down or more down, they don't necessarily need to bring up a cash difference in a low appraisal. Why? The max amount of money a lender is willing to give on a home is 95% the value of the house.
Right.
So if you were buying a house for $1 million and you were putting $400,000 down and wanted a loan, that was the difference, right?
Yep.
If the appraisal comes in 200K low, the value is 800,000. You still have the 400,000 down payment. So if the lender is still willing to give you 600,000, you can still meet the sales price.
Right.
So what you do is, okay, if the appraisal comes in 200K low and my loan 600,000, what's the loan to value? How big is the loan in comparison to the new value based off the low appraisal? Well, you do 600,000 divided by 800,000, it's 75%. The lender's still going to give me 75%.
Right.
That it's not 95. 95 is where they cut you off.
Yep.
So if you're putting a large down payment, you're basically building in a buffer where if the appraisal comes in low, lender's still willing to give you that much money.
Yep.
You still have all the down payment you promised to give. You can still pay the seller that much. The question is, are you okay with whatever financial implications there are of the low appraisal? Because now that your loan to value is 75% instead of 60%, the lender might have a different interest rate for you. Or you might have to pay points to keep the same interest. So what you do is, before someone offers, once I know the sales price and the loan amount, I talk to them. I say, if the appraisal comes in this low, you might pick up private mortgage insurance where you didn't have it before. Your private mortgage insurance might go up where you didn't have it before.
Right.
Or your rate might change because you had a certain percentage loan to value before and now it's higher, so your rate's different. I walk through what the scenario actually looks like if the appraisal comes in X low.
Yep.
If they're comfortable with it, we can offer appraisal gap coverage of that amount.
Right.
And test it a little more. Are you
Yep.
comfortable? Okay. Are you comfortable? Eventually they go, I'm not comfortable. And that's how much appraisal gap coverage you can offer.
Got it.
Or eventually they're comfortable with everything, but I'm like, well, you don't qualify anymore. And that's the most they can offer.
Yep.
But if you put a large enough down payment, you've built in a buffer for a low appraisal where you don't need to bring any extra cash if an appraisal comes in X low. You just need to be comfortable with what the implications would be to your financing.
Right.
And so that's something I trial and error before we offer.
Yep.
Basically, if it comes in this low, like this is what happens to you. You cool with that? Okay, now we can offer to the seller if it comes in X amount low.
Right.
Negotiating with you, our financing doesn't fall apart, and you've built in a appraisal gap coverage without needing to bring cash.
Oh, that's smart. That's a good idea.
So that's like one thing with appraisal gap coverage where someone's putting 15, 20, maybe even 10% down in a competitive market. It's like, we should be talking about it. We should be doing everything we can to make ourselves more competitive.
Yeah.
The other one is, hold on, pre-commitment letters. So basically making the short story of it, at my company, we can pre-underwrite files. So rather than me reviewing all the documents and the application and saying, this one's good to go,
Yep.
I send it to an underwriter and they review it. Basically, so that when we offer to the seller, we're
Yep.
using a letter that says it's been pre-underwritten. And when I
Right.
call the listing agent to vouch for how strong the buyers are, I can be like, don't take my word for it. The underwriter did this,
Yeah.
like literally looked at it. They've approved it. We're just waiting for a house at this point in time.
Yeah. Oh, that's great.
And since it's already underwritten, we can offer very quick closing times. So we can also be like, hey, 20-day close,
Yep. Yep.
So what I've done a lot is when I've pre-committed people, I have, like, they suggest that the buyers be looking on Thursday to see what new inventory comes out.
Yep.
And if they're allowing for showings ahead of time, go and look at it Thursday night.
Yep.
They like it and they want to offer on it, put in a nice, strong offer that night before anyone else does and make it
Right.
expire on Friday.
Yep.
And say, we can close in 20 days, take it or leave it.
Right.
If you catch a buyer who's trying to get out of that house quick, they
Yep.
already have the home they're purchasing lined up.
Yep.
It's vacant and it's a family trying to make their money.
That's smart.
Good offer. There's no competition. If it's not a good offer, they're going to wait for more. But if it's a good offer, instead of fighting in the top three, you're the only one.
Yeah.
You're giving the realtor the chance to remove the open houses over the weekend. Because once the open houses start, they're going to have a tough time telling the seller, we should just not even wait for other offers.
Right.
But if Thursday night, that realtor looks like a hero too. We got an offer before you even got to live in houses,
That's good. Yeah.
That's a good opportunity to be like, in the right scenario, like, we can wrap this up in 20 days for you. You listed it today, we'll close in 20. You know
Yeah.
what I mean?
Yeah.
So that's a second strategy I've used to try and keep people competitive in a market like this.
Yeah.
So I mean, that's a pretty good one. And then the two other things we do with portfolio lenders. So if you have someone who's slightly outside the box, a weird employment history that makes, they went from full-time to part-time.
Yep.
Full-time's not variable, it's fixed. Part-time is variable. You need a year of variable income to use someone's income on an application, which sucks because like you have a doctor who is full-time and they go to part-time and you're like, oh, sorry, doctor, you can't afford this right now. Like,
right.
Yeah, you have a minimum 32 hours as a part-time worker, but since you're variable, a lender needs a full year history to count.
I just think how that works.
We have portfolio lenders. So if you go to portfolio lender, like, hey, portfolio lender, this is outside the box. It doesn't work Fannie or Freddie, but it's a doctor who's working minimum 32 hours. They're technically part-time, so it's variable. Yeah. But we're just going to do 32 times the base rate. You cool with that? And if they're cool with it, okay, we have a portfolio lender.
We'll go from there.
The box stuff, don't just think it's dead until it's ready to go. Try out the portfolio lenders first. See if there's, and we work with them. So like I can vet through our partners to see if we have a home for it.
Yeah.
The other one is rescue loans. If you have a deal going on and it's just going sideways for any particular reason, if you can identify the specific problem with the underwriting, we do rescue loans. So I've closed things in 18 and 16 days when it's been falling apart other places. Yep. Because you can identify the problem and say that, figure out we have a solution. We can basically alert my team that it's a rush file for a rescue loan, and they drop whatever to do that one. So we had one where there was problems with the appraisal. They needed certain fixes. The seller wouldn't do them. The buyer would do them, but not until they owned it. But the lender was saying until they're fixed, we can't close, which is fair. The appraiser called them out. We got a copy of the appraisal and we're like, hey, our appraisal department, our escrow department, because we have to order our own, but if we got the same issues, do we need these fixed before, or can we let the buyers put money in escrow to fix it after and close based on that? And our team was like, yeah, we can do that.
Yeah.
So the application, rushed the appraisal, got everything good to go, closed it in like 16 days.
Yep.
Funny thing was the appraisal came back with none of the issues that the other appraiser did. So we didn't have to do that solution. But the point is, if you identify the problem and we identify the solution,
yep,
then we can say, okay, rescue loan, bring it in. We're going to drop what we need to get expedited, and we close it hopefully on time.
Yeah, that's cool. What do rates look like as far as like portfolio loans go? Is it pretty like similar to?
It depends, because it really, what it is a relationship with the bank. So it depends on what that bank's rates are. We have one that, like, honestly, their arms in the high sevens. But the point is not to use them because their rates are good. The point is to use them because it's like Mr. Self-employed person who sells yachts, but had one sale back last year that lost you millions of dollars.
Yeah.
Any bank can look at you and be like, you're super rich, you can pay this back. It's finding the one that's like, we get it. Your tax returns look like junk, but it was one thing that happened.
Yeah.
You might be like, screw it, I'll take a 7-1 arm paying a point at 8%.
Right.
Just for the sake of buying the place until my tax returns are better, So
it's a little more specialized. You just need someone that like will see through the.
Yeah. Sometimes you get a relationship where it's like that little bank that has very low rates because they're just unaware of how stupid they're being. Right. Not to make fun of them, but it's like they regret it. They move it up eventually, but you might catch them at that point in time, at which point you might use them for rate. Or if you're lucky enough, they're also the solution to a problem. And they happen to be really good.
Right.
So, that high one that I use for an example is that the arms at 8%. They might be good for second homes because they'll do vacation properties.
Right.
So that could be a good use for them for a rate purpose. So the right scenario, sometimes they are good for rates, sometimes they aren't. It depends on the scenario, but they're mainly good for outside the box stuff.
Cool.
Yeah.
That's awesome. I know you got an appointment in 1 minute, so I don't want to keep you here. I just really appreciate it. It's super helpful. Cool.
Yeah. Sorry that I rush off because in all honesty, these are my favorite conversations. So